This is the Aftermarket Radio Network.
Welcome to another episode of Business by the Numbers. I'm your host, Demarest, CPA with Parmelis & Associates. Should you record your sales when the deposit actually hits your bank account or when you actually sold that job? Should you record your parts cost when you actually installed that part on a customer's car or when you decide to pay your parts vendors? Should you record your payroll when you actually pay your team or when that team actually did that work? If you don't know the answer to these questions, this week's episode is for you. Accrual accounting, cash basis accounting, what is it? What is the difference? Is everything that we're going to talk about this week. Remember, if you want to hear your question answered on here or have an idea for a week's episode, just like this week, it came from a listener, or want to be on an episode, shoot me an email at podcast@parmelis.com. And lastly, we cannot forget our dedicated sponsors, NAPA and Promotive, for being such loyal supporters of the show. For over 30 years, NAPA has made selecting the right shop management system easy by offering the best, most comprehensive SMS in the industry. We'll prove to you that Trax is the single best shop management system in the business. Visit them online at napatrax.com. That's NAPATRACS.com. If you're looking for a full-service staffing solution that does everything from sourcing, qualifying, creating job descriptions, scheduling interviews, to negotiating job offers, Promotive is your answer. Visit them online at gopromotive.com. I was actually talking with my clients today, Chuck and Melissa. So Chuck and Melissa get a special shout out, as I told them that they would, for giving me the idea for this episode. Go down through talking about some different things of a mutual client that we had here on a cash versus accrual. And one of the things that I laughed about is I give Chuck a lot of credit. So Chuck works with a lot of shops out there and is really sharp on the financials and gives great advice. And some of these are mutual clients, and they'll come back to me and they'll say, my coach told me I should do this. And the one thing that we were talking about today and we're talking about this week is accrual-based accounting. So I was laughing with Chuck because a lot of my clients, or some of the clients, will come and say, we need to do in our books accrual. And then I'll have to educate them, you're already doing these accrual. And so what we realized is a lot of people, I think, hear about accrual and a lot of people know that they need to be doing accrual-based accounting. But I don't feel like, or I feel like there's a large amount of people that don't know actually what that entails. This is exactly what I want to talk about this week is what is accrual-based accounting? What is the difference between accrual accounting and cash basis? And then how do you actually do this in your shop? One of the things we're also going to talk about is where do we stand on that spectrum? Because you can accrue just about anything. And if you want to go full accrual, as far as where that is from where you are now, it really depends on what you're doing, but you can spend a lot of time and get into some nitty-gritty details where for a business doing $10, $20, $30 million might be material amount to accrue, but we're not looking at spending hours to accrue $10 here or $100. This week is also to be able to go down through, get you guys an understanding of what accrual-based accounting is, maybe where that would differ from how you're doing stuff right now, but also be mindful of we don't want to go down and completely get lost in the weeds and lose the ultimate objective of what we're trying to do here. To set the stage, why do we want to do accrual-based accounting? We want to do accrual-based accounting because accrual-based accounting is generally a more accurate way and is always a more accurate way if you're a shop because it matches a lot closer to what the business is actually looking like in real life compared to what it actually is looking from a cash flow perspective. We have two different types of accounting. We have cash basis and we have accrual basis. What is the difference between those two? So the way to think about this is fairly simple. Cash basis is just that. If you paid the cash out, you have the expense. If you got the cash in, you have income. If you have not paid that cash out, you do not have an expense. And if you have not received that income, you do not have any income. So it's just very simple of kind of a lemonade stand, right? Money in, money out. You don't have any differences between the two. We only record stuff when we get it. A lot of people, when you start off your business, maybe start on cash basis. It's in the simplest form, the way that we like to think about it. Income comes in, income goes out, fairly straightforward. As your business grew, you probably had to start to have some complexities as well too. Maybe all that money doesn't come in at the same time. Maybe you have fleet accounts. Maybe you allow people to make payments on this. The same flip side, when you first started your business, maybe you were COD for all of your parts houses. Maybe you had a card on file at the dealership and you did not have any credit terms. So there's some of this is from a necessity standpoint. If you got a business that's doing $20,000 in sales a month, it's probably not going to have as much adjustments to go accrual basis as a business doing, say, $200,000. Keep in mind that if you're looking at yourself and saying, man, I feel really bad that I haven't been doing this along the way, the smaller your business is, the less that it probably necessitated this change, and also the less of a variable between cash and accrual. The official definition of this is accrual accounting. Where it differs from cash is recorded when it is actually paid. Accrual is when it is incurred. So if that income was earned or incurred in this period, we're going to make it reflective this period, even if they got paid the next one. An expense. If we incurred that expense right now, I want it reflected today, even though I might pay that the 10th of the following month. To put this into even a little bit more specific examples here, let's say I do a $2,000 sale today and it's a fleet account. If I'm cash basis, that doesn't hit my books whatsoever. Because I have earned that money. I did have that sale, but my fleet account hasn't paid me yet. So that is not going to hit my books until next month. If I'm on accrual basis, that gets posted to accounts receivable and that hits the books today. What do you think would be more accurate if your financials are trying to paint a picture of what your business is doing? When you actually show that $2,000 40 days down the road, or today when it was actually incurred? If you're thinking to yourself 40 days down the road, you had a 50-50 shot and you got that one wrong. It's always going to make more sense for those numbers to match up with what we're actually doing. If that technician that did the work today, do you think that it would make more sense to match up that $2,000 sale today when we're going to have the corresponding payroll and overhead? Or 45 days down the road when that person might not even be there, we might have a different overhead. It's going to smooth this out. It's going to make a lot more sense. Also, think about it this way. If we're going to be looking at a fleet account, let's say that we do $2,000 a day and we see one of these guys every single day. At the end of the month, or after the month is closed, they give us a $30,000 check next month. But really what that is a couple $1,000s for every single day this month. It's not going to make any sense to post that when it's paid. We need to make sure that it's matching up of when these expenses are incurred. On the other side, for expenses, it's fairly similar. If I go out and I buy a bunch of parts today and I get put on a car and I get paid today, but I don't owe NAPA or I don't owe CarQuest and for another 40 days, do you think it would make more sense to match up that expense to when I'm actually showing the sale and when I'm actually paying the payroll, or 45 days from now when I actually pay that bill? We've beat the dead horse. You get what it is. We're matching up for when expenses were actually incurred and when income was actually earned. It could be the same as when we pay it, but sometimes it's a different date. How do I do accrual accounting if I'm not so already? If you're thinking to yourself right now, I don't even know what this is. This is the first I've ever heard of it. Then you probably aren't going to be doing all of this stuff already. Like I said before, accrual-based accounting and how you go from cash basis to accrual basis is a spectrum. It is a sliding scale. There are some things that we are going to talk about here that you need to do. It's a non-starter. Don't ask it. Don't question it. There is also a spectrum where you can get to the far end of it where I might say the exact opposite. You can accrue that, but I'm not sure that you really need to. An example of that would be, let's say that you go out and you pay for an annual subscription for some small app that you have. It's $60 and you pay it one time a year. Technically, that $60 is not due today, but we should have been recognizing $5 worth of costs for the preceding 12 months or for the subsequent 12 months. We're not paying $60 this month, it's really $5 a month. That is accrual accounting, and technically, if you want to be full accrual, every expense just like that needs to be sorted out and accrued. You would see that you would never want to do that. It's $5. It doesn't make any sense. It's not material. How much time are we going to spend? So the big thing on here, when you look at accrual, you need to think to yourself, all right, is this material? Like moving these charges around, is it going to actually make enough of a difference? And then how long is this going to take me to do? Another one that sometimes comes in on here, and we'll talk about some of those a little bit more when we get down to the expense category. Let's start with the first one. And the first one on this is sales. And the reason that this is first is this is the most important. This is also the easiest, but this is the one where if nothing else, if you don't do anything else today, you need to do this one. What this goes back to is if you look at your financials and you see in your sales categories, check deposits, credit card clearing, outside financing, cash, check, then you are probably doing this cash basis. Even if you just see one big sales category that just says sales or says total deposits, you are not doing this correctly. I want my sales to be split out just like I see in my shop management software. Parts, labor, shop supplies, sublet, tires, etc. And within reason, those sales should match exactly my shop management software. You might be thinking to yourself, Hunt, they don't match because I don't always get paid this month. I get paid next month. How am I going to be able to adjust this and make sure that all of this stuff jives and is correct? We have a shop management software. This is how we're able to do this. How do you actually implement this? How do you switch from a cash basis to accrual for sales? So there's a number of different ways that you can do this. You can use an integration like back office, accounting link. That will actually dump all of the sales over there. And if you post this stuff to accounts receivable, it's all going to come over and it's going to match up exactly. Now, do you need integration in order to do accrual-based accounting? No, you do not. And even a lot of my clients that do ultimately end up doing integration, we show them how to do this stuff manually behind the scenes. And if you want to do this manually, there's resources out there. There is videos that we've done on this. I don't want to get too into the weeds on this because I think it's a little bit confusing to explain just verbally on here. But the general idea is that you can do a daily sales entry. What the daily sales entry looks like is it's reconciling the sales to the deposits. If we're looking at this and our daily sales today was $5,000, but we only received $4,700 in deposits, we're going to have to figure out where the difference is. The general idea on it is we're going to credit the sales. So we have parts, labor, shop supplies, sublet sales. We also probably have some sales tax, so that's going to go in there as well. We're going to look over there and we see we have all these sales and all these taxes. If we got paid the exact same amount in cash, we don't even need an entry. Those are going to match and those are going to jive. But generally what you're going to see is sales are either higher than your deposits, and we know that that difference is going to go to accounts receivable and increase it, or our deposits are going to be higher than our sales, which means someone pays us out of accounts receivable and we're going to reduce it. In a perfect world, your sales match to the penny in your QuickBooks compared to your shop management software, and also your accounts receivable does as well too. Because remember, if sales go up and we didn't get all the deposits, it's going to be sitting in accounts receivable, money that is owed to us. Now, the sales are already recorded 15 days down the road when that customer pays us. It's not going to hit sales because sales are already posted. It's going to go into accounts receivable. It's going to come out of there and go into our bank account. Once we have recorded the sale, the profit and loss is never going to change because the sale is already recorded. The only thing that is now going to change is on the balance sheet because we have cash and accounts receivable. So this is allowing us to lock and have our profit and loss match the actual sales on the day that it happened. Also allows us to do everything else that we're talking about here today. This is why this is so important. If you're going to do nothing else, do this. And if you're not going to do this, don't do anything else. Because if you don't accrue your sales, there's no reason to accrue your parts. There's no reason to accrue the payroll. You're already missing the boat and probably the biggest material amount that it doesn't make any sense. Now, have I ever seen a shop that accrued everything else and not sales? No, it's fairly unrealistic, but I just got to stress how important that is. Sales should be what you sold that day, not what you were paid that day. That is the big thing you need to remember. And at the end of the day, your sales in QuickBooks should match your shop management software. Should it be to the penny? Yeah. Is it going to be? Probably not. You can post stuff in previous period. There's going to be adjustments. But if I'm looking at something and it says my sales were $135,300 and I look at it and it's $135,301, no, I'm not freaking out. There is going to be just some intricacies, adjustments, changes, etc. Now that we've answered the question of what is accrual? Am I accrual? Then you ask yourself, am I accruing my sales? Do my sales match my shop management software? So if you're saying to the answer to this, yes, they do, perfect, move on to the next one. If you're saying to yourself, Hunt, no, they do not, I shouldn't say stop this episode, but to a certain extent, listen to the rest of this episode. But remember, you're starting with sales before you do any of this other stuff. Let's face it, your shop management system is the single most important tool in your shop, period. You need NAPA Tracks because it integrates with all the major players, including NAPA ProLink, Parts Tech, OE RepairLink, Epicor, Tire Connect, Mitchell 1 Pro Demand, and more. NAPA Tracks has leading-edge tools and technology that your shop needs right now. Unlike the other guys, we'll be there after your installation with the best training and support in the business. Your training includes a learning management system that is tailored to each role in your company. Simply put, Trax was designed and built for shop owners just like you. It all starts when a local representative meets with you to learn about your business to help optimize your shop's workflow, efficiency, and profitability. For over 30 years, NAPA Trax has made selecting the right shop management system easy by offering the best, most comprehensive SMS in the industry. After all, it's your shop, so it's your choice. Visit us on the web at napatrax.com. That's NAPATRACS.com. Shop owners, are you struggling to find and retain top-tier talent for your automotive shop? Introducing Promotive. On the web at gopromotive.com. With over 40 years of combined industry and recruiting experience, we're the ultimate staffing solution. We go beyond traditional agencies. Our team provides dedicated recruiters and account managers advising on processes, compensation, and benefits. We focus on placing technicians and service advisors with shops that offer the best culture, training, and long-term growth opportunities. Trust our experience to match the right talent to your shop. We carefully select shops that value employee excellence and provide an environment for success. Our dedicated team leads the entire process, leveraging our industry knowledge and expertise. Partner with Promotive and experience their advantage to help you build a high-performing team that drives your shop's growth. Visit gopromotive.com today and let us help find and keep the best talent in the industry. Honestly, when I see most shops' financials, if you're one of our clients, you're already doing the sales. Those are going to match. Those are going to tie dead on. We don't have a single shop. We used to have some people that like to do this old school because they had a different reason. Every single one of our shops, the sales match. It's just a procedure. You're not going to be able to find someone that doesn't. On the cost of goods sold side, again, this is something that 95% of our clients are doing. 5% are not for whatever reason. Either they don't want to, it doesn't make sense, etc. These are the two things that we need to be doing for everyone. But generally, we already see sales when it comes in the door. A lot of times we are adjusting the process or how we're recording the cost of goods sold side. I will tell you on the cost of goods sold side, and we're talking really about parts here, that sometimes you don't need to do this. I'm going to still say you probably have to, but some of you guys actually don't need to accrue your parts because you're COD. If you have a credit card on file with the dealer, with the parts house, and every time they deliver a part, every single day they hit your credit card, you probably don't need to do anything else because all of this stuff is pretty much already going to get hit. Because there is no difference between when the cost is incurred and when it's paid, because you're incurring it and paying at the same time. For everyone else out there, you probably have 2 to 3 big vendors that you pay on credit terms. You go and you buy all your parts from NAPA, CarQuest, O'Reilly's, and then the 10th, the 15th of the following month, you pay your parts bill. What you need to do is fairly simple. So right now, if you are entering that bill, you're going to enter that bill in on, let's say, November 10th, even though that is going to be an October expense. If you're already entering the bill, then the only thing that you need to change is on that bill, instead of saying November 10th, you say October 31st. Whatever day you put on that bill in QuickBooks is when it's going to show up on your profit and loss, no matter if you pay that bill next month or the following month. That bill date is very important. So if you're already entering a bill, the only thing that you need to change is make sure that that bill date is reflective in the month that those expenses were incurred and not the bill date that that was sent out. If you're thinking to yourself, Hunt, I don't enter any bills into QuickBooks. I just write a check out whenever I pay the parts house. If you have a smaller one, if you only buy a couple $100 of parts from this vendor every single month, then maybe you don't need to do it for that one. But you need to do it for your big ones because that's going to be enough to swing this. So instead of writing a $20,000 check and coding it in this month's parts cost, I'm going to have one extra step when I pay my parts bill this month. What I'm going to do is I'm going to say, all right, here we are, a week or two into the following month. I need to write a check to NAPA for $20,000. I'm going to go and I'm going to create a bill in October so that I can post this expense for October. And then instead of writing the check to NAPA, I'm going to go and pay this bill. That check is still going to go out for today. It's still going to be in this current month. But since we posted that bill to the correct period to October, we know the expenses are going to be categorized correctly. I have to stress this again. If you have a credit account, if you have a parts house that gives you credit terms on this, you need to accrue those expenses. Because what ends up happening if you do not do this is we have hangovers. So if you have a really good month followed by a pretty bad month or just even a down month, we have all of those increased parts costs that are going to carry over into the following month. And so what ends up happening is when you have a really big month, it looks even better than it really was because your parts cost is going to be lower than what it really is because some of those expenses are pushed forward. And then the following month is going to look much worse than it really is because we're going to have lower sales and higher than average parts costs because those parts are leaking over into the other month. Depending on what level of detail that this goes in there, there's always going to be stuff that carries over. Longer term projects, maybe you have an engine job that get carried over into the previous month. We're going to try to stamp as much of that stuff out, but you're always going to have that. And so when I tell my clients, we're not shooting to have zero variables in our financials. There's always going to be something where if you look at this and you're going to say, I was expecting that to be 50%, it's 42%. Oh, but I know this, and this is happening. That's normal. Do not ever shoot to have zero variables in the financials that there isn't going to be some context that you might need to add, but we want to knock out the easy ones. Let's eliminate all the easy variables that we can just have process and procedures so they're not even in there at all. Isn't that going to be a lot easier than trying to say, all right, but I did this, back that out, add this. The easier these financials are, the more accurate, the easier are they to read, the easier they're going to be able to implement and actually use in your business. Sales, parts cost, no-brainers. You got to do those. Let's get into our last two, which is going to be payroll and then all the other overhead. Payroll is another one that I wouldn't say is commonly accrued. It is sometimes accrued. The idea behind payroll is if you're weekly, when you pay this Friday, you're actually paying for the previous week. If you're bi-weekly, then you're paying this week for the previous 2 weeks, but actually even a week delayed. You can imagine here that if you are not accruing your payroll expense, especially if you're bi-weekly and especially if you're flat rate or commission based, when you actually pay this stuff is getting farther and farther away for what is actually incurred. If you are having issues where your payroll cost is swinging drastically and it's affecting your ability to read the financial statements, then what we do for those clients is we can actually start accruing those. If you look at this and you say, all right, the first week of pay that we had for this month actually needs to go back to the previous month. So we would actually accrue those expenses the previous month. But then the same flip side of it is if we look at the end of this month, we're going to have to say, we need to actually bring back some of those expenses for next month into this current month because 3, 4, 5 days of this current pay period leaked into the following one. This is the big thing on this one is you got to see if you actually have a swing because sometimes we might be moving this one to the previous month and this one to the next month. But if we're just swapping around apples to apples, we're moving these around to different areas, but the overall amount is still the same. If you're weekly and you pay all your guys hourly and it doesn't really change that much, are you going to be able to get a higher level of accuracy by accruing those? Yeah, absolutely. Is it material enough where it's actually going to change your financials or change your decisions? Maybe, maybe not. Now, if you're bi-weekly and you're flat rate and you're seeing a lot of volatility in your books, then yeah, you should probably do this. And this is why I like to throw these caveats in there, is because if you're looking at your financials right now, whether you're cash basis, whether you're accrual basis, whether you're flat rate, whether you're hourly, and you're looking at your labor costs and your labor gross profit margin, and it's pretty darn consistent throughout the year, then there's probably no reason to do too much to change that. If you are having big issues where you're looking at, and I'm saying, I got 80% labor gross profit this month, it goes to 45 next month, up to 70% the following month. Not only do you probably have a little bit of a productivity issue, but if you have a productivity issue, it's probably going to magnify the accrual or the lack of accruals even more. Does that mean that everyone listening to this episode needs to go out and accrue their payroll? No. And probably half or the majority, you do not need to change this, and you still have good, accurate financial statements. But some of you also, depending on how much this swings, are probably maybe muddying the waters a little bit on your financials by not accruing this. Again, some of you guys are already doing all of this already. The last one on here, and I did rank this in importance, or I shouldn't say important. All this stuff is important, but probably most common. Sales, everyone should be doing. Cost of goods sold, vendor accounts, everyone should be doing pretty much. Payroll is starting to get into, if you're having issues, you can start accruing that. If you're not, maybe you don't need to worry about it. And then this last one is expenses. I kind of group in all the other overhead expenses. The reason why we don't see as much on expenses is there's just not as much things that change enough where it's really necessary. Like, I'll give you a great example. When you pay for your health insurance, you're either paying for the month ahead or the month prior, but probably not in the period that you're paying it. But why am I going to accrue my health insurance expense for the next month when it's the same amount every single month? I don't necessarily care that that $2,400 bill is in September or August, as long as I have one bill in every single month. Some of these that are recurring amount, like your utility bills or Comcast or health insurance, it doesn't make sense to accrue it because we're moving the same amount to this month to next month. The end result is the exact same thing. Where I have had this, where I did agree with this for overhead, is some of my clients have really high property tax bills. So like one of my clients, he had like a $36,000 property tax bill that he had to pay once a year. Obviously, if we put $36,000 of expense in 1 month, that 1 month looked really crappy, even though essentially what it was is $3,000 every single month. For him, what we do is we accrue $3,000 worth of property tax expense every single month. And so we accrue those expenses. You're going to see property tax expense on the profit and loss. And then we have a liability, either in a bill, a payable, or just a regular liability on the balance sheet. Every single month, we got $3,000 hitting the profit and loss, $3,000 building up in this liability. And so if we look at that year of financials, we can see consistent, smooth expenses for property taxes. And then when that bill actually comes due, we're paying off the liability on the balance sheet. So we're smoothing that income and we're actually showing a more accurate picture. That's a perfect example. And if that is the case for you, that is an example of what probably should be accrued. The other side of this, you could have a big argument on there where people say, Hunt, I do pay an $8,000 property tax one time a year. But when I pay that, I will look at that and keep in mind when I'm looking at my financials of this is probably artificially too low, where I know that the other months are artificially a little bit too high. So this is where the materiality comes in. You can see that $8,000 property tax bill, probably not going to accrue. $80,000 property tax bill, I probably will. Keep in mind of that materiality does make a big decision. One of the maybe more egregious ones that we were asked to accrue is, I think it was life insurance. It was some sort of insurance policy. And so my client had to pay $600 for this policy one time a year. And he says, this is not fair. We need to accrue this. At the end of the day, if you want to get it accrued, we will accrue this on it. But then this is one where we had to educate our client. We can, but it doesn't necessarily mean that we should. What we're doing right now is we're posting a $600 expense into a business that does roughly $150,000 a month in sales. This is even a blip on the radar this month, let alone enough for us to go and accrue this over 12 months to say, let's put $50 a month for 12 months instead of $600 in one. Now, again, if that insurance plan was a $60,000 insurance plan, have a completely different idea. Amount matters. At the end of the day, though, these are your financial statements. If it matters to you, it matters to us. And if it matters to you, it should matter to your accountant. The ultimate objective here is to get you to understand your numbers, to you to know what you're looking at, and for you to know what these numbers mean and how you can move the levers to ultimately improve your business. There is no shop out there that shouldn't be recording their sales to AR. And arguably, there should be no shop out there that is not accruing their parts expenses. On the cost side of things, maybe not accruing all of them, but at least doing the top 3 vendors. And if you're doing this, your books are going to be 95% of the way there. Depending on payroll structure, depending on overhead, depending on amounts like we just talked about, maybe you could use to do more, but make sure you're working smarter, not harder. Please share with friends if you have any questions, comments, or ideas for future episodes. please shoot me an email at podcast@parmelis.com. Just have to say thanks again for listening on the Aftermarket Radio Network. And thanks again to Chuck and Melissa for this idea. But if you want to find all shows, you can check them out on aftermarketradionetwork.com and on your favorite podcast listing app. So thanks again for joining me on Business by the Numbers. Stay safe out there, and I will talk to you all next week.
You've been listening to Business by the Numbers with Hunt Demarest on the Aftermarket Radio Network. Follow Hunt on your favorite podcast listening app. Let him know what you'd like him to cover. His email is in the show notes. Hunt is all for advancing the aftermarket.